Good afternoon, ladies and gentlemen, and welcome to the LGIA Super Annual Members Meeting for 2020. Before I begin, I'd like to acknowledge the traditional owners of the land on which we meet today and pay my respects to their elders, past, present and emerging. I'd also like to cover off on a little general housekeeping. For people here in the Brisbane room, the main entrance and exit is the door you came in through earlier. Bathrooms are located to the right of the main entrance to the Brisbane room, with more bathrooms located across the balcony, past the lift and down the hallway. If you hear an alarm, a beep, beep, beep alert tone, please collect your bag and stand by in case we need to evacuate the building. And if you hear a whoop, whoop, whoop alarm, that means we will need to evacuate the building, and you'll hear an announcement telling you that, and I'd ask you please to listen carefully for directions, and when you hear that, please make your way in a calm and orderly manner towards the nearest emergency exit. You can see the signs around the room here. Your nearest emergency exit is at the back of the room where you came in. You take the stairs that'll be on your... Are you going to remember this when you hear the alarm? The stairs will be on your right as you exit the room. You walk down to the ground floor foyer and exit via the Ann Street doors. You are to meet at the assembly point, which is the King George Square deck, which is conveniently located above the Pig and Whistle pub. I'd like to outline the agenda for today's meeting. You will hear from, in order, LGIA Super Chair John Smith, CEO Kate Farrer and the CIO Troy Rick. And of course, we'll have questions and answers, Q&A. And following the Q&A session, light refreshments will be served where you can meet members of the LGIA Super team. Now, for those interested, we have LGIA Super staff on hand to offer super health checks, as well as members of our advice team and executive leadership team here as well to help you with any questions you may have. Please note, we don't have the full ELT here in the room. Only some here through COVID restrictions, and obviously this is a very COVID compliant event. In terms of housekeeping for the questions and answers session, there are 4 ways you can ask a question. For those here in the room, please raise your hand, and our staff, Ultan and Yusuf, will be running a microphone to you, and I'll then direct to the correct speaker here to respond. If you'd rather not speak in front of a large audience, not just here in the room, but also upstairs in the Kedron room and perhaps watching online as well, you'll find a pen and notepad in the pack you received when you came in today. Please write down the question and hand it to Ultan or Yusuf, and they'll read the question out on your behalf. And again, I'll facilitate the response with our speakers here on stage. For those joining us via the webinar, good afternoon to you if you're on Queensland time, or good morning perhaps if you're listening in another part of the world. You can also submit questions, and we particularly welcome those via the Redback live webinar feed. You simply click on the blue hand on the right side of the screen to submit your question. We look forward to bringing those into the conversation today. And some, of course, have already submitted questions when registering, and we'll be getting to those as well. Now, if you start to feel unwell during the event, please find a LGIA Super staff member or a security person at the entrance, and they'll take care of you. And without further ado, it's my pleasure to hand over to the first speaker for today's annual members meeting, the chair of the LGIA Super Board. Would you please welcome Mr. John Smith.
Thanks, Tim, and good afternoon, everyone. Thank you for joining us for LGIA Super's annual members meeting. So this one's covering the last financial year for 1920. The first 8 months of this year and the last 4 presented very different opportunities and challenges for the fund and the board. For the board, it's the second year where we've all members of the board have been working together, and I'm very proud of the relationships that we've developed and the fact that we work as a team. We've endorsed new strategies for the fund and for the benefit of our members. The year started with us responding to some significant legislative change, more change than I've encountered in the 40 years that I've worked in the super industry, and concluded with a pandemic and one of the most severe downturns in economic activity in Australian history. So in many ways, this will be a year to remember. Investment performance looked pretty good at the start of the year. Strong share market activity in the periods leading up to February. In fact, I recall speaking to Troy Rick, our Chief Investment Officer, at the end of February, and we were talking about how strong the investment performance was, both in an absolute level and also relative to our peers. But we then saw a very sharp downturn as a result of the oil price crash as well as COVID-19. But share markets have been recovering since March, and to such an extent that MySuper investment option generated a positive return based on unit price movements for the financial year. We were one of only 16 Australian superannuation funds in the Super Ratings SR50 MySuper survey to have posted a positive return for their MySuper option on that basis. In fact, all our diversified options posted a positive return for the financial year. The spread of COVID-19 globally has resulted in a global economic slowdown. The second half of the financial year, we implemented two major pieces of legislation change that the government was introducing to support people during COVID-19. The first was the early release scheme that you may have heard about. In this scheme, members could access up to $10,000 in last financial year and a further $10,000 this financial year. There was also a temporary reduction in the minimum withdrawal amount for pension accounts. So as a fund, we were very, very happy to be able to help those members who were so severely financially affected by the impact of COVID-19. And last year was also a transformational one for us internally, with the delivery of a major technology partnership that aims to reduce administration costs of serving our members. These costs could halve over coming years. The transition was completed on time, without any disruption to our member service, and over the coming year, members will see a significant benefit from this project, including improved digital services and reduced fees. The board and I are very grateful to the members of the team, led by the executive leadership team, and our partner Tech Mahindra for successfully delivering this extraordinary project. As an organisation, we've had to adapt very quickly to the circumstances we are in COVID-19 environment. Our resilience and boutique size enabled us to overcome the evolving challenges. Troy guided us through some very challenging times in financial markets and helped minimise the impact on members' savings and seize investment opportunities as markets started to recover. Through good planning and the long-term focus, Troy and the investment team were able to deliver competitive returns for our members in what was a very challenging year. The final result for the financial year of 0.2%, unit price return for our MySuper under 75 and 1.1% unit price return for our MySuper 75 plus members was a very competitive result in the circumstances. This is testament to the work of Troy, our investment team, and LGIA Super's long-standing diversified investment approach. And Troy will provide some more details about that a little bit later. So despite the challenging circumstances we found ourselves in, the fund is in a very strong position. One major factor has been the successful implementation of the Tech Mahindra partnership that I mentioned earlier. That has allowed us to create administration service for the fund can smoothly and efficiently administer more than the 75,000 members we have now. So having more members means that the cost of running the organisation can now be spread over many more accounts, and that benefits will flow through to you in reduced fees. Members have many times asked me as we travel around, John, are you considering about a merger? It's talked about a lot in the press. Until we did a great job with the administration system, we really couldn't consider a merger. But now, we recognise now would be a good time to consider seriously a merger in this marketplace. It's no secret, and you may have heard APRA, our regulator, has been very outspoken in terms of consolidation in the industry. There's every possibility we'll have more regulatory change that we need to respond to, and the bar will be set very high for you to be a superannuation fund in Australia, and so it should be. In this environment, we're committed to ensuring that our fund is well placed as one of the top performers, and working proactively to be the best fund possible for you, even when this requires change and transformation. So at the start of the year, the board commenced a detailed process of looking at other funds in the marketplace and identify someone who would be a potential merger partner. And this actually led us to single out Energy Super. And this culminated in October with the announcement that we would sign a memorandum of understanding to enter into exclusive due diligence with Energy over the coming months. This isn't about becoming a massive organisation, nor being a mega fund with millions and millions of members. We understand that the members choose us for our personalised approach, so that won't change. For the merger to proceed, both boards and the regulator have to agree it's in members' best interest. That's all members' best interests. And of course, it would only proceed if we could ensure that we can align products and services, both defined benefit members and accumulation members, so that they can access a product that's equivalent to your existing product at a reduced cost. So we have quite a lot of work to do to answer those questions before we proceed. Our CEO, Kate Farrell, will tell you a little bit more about Energy Super later and the process we're following. So whether we proceed with this due diligence and it results in a merger, please be assured that LGIA Super is committed to remaining a community-based fund, open to all, but retaining very, very strong links with the local government community and local governments across Queensland. We will continue to work closely with the local government sector to provide services and employer support that make sense for local government employees. We would also continue to find opportunities to co-invest in assets that will benefit our members and their communities. So this will be an area you'll hear a little bit more from us in the next 6 months or so, and our commitment is to communicate with you every step of the way. I just wanted to spend a little bit of time about the governance of the fund. Good governance is essential to operating a responsible and sustainable fund. As a profit for members public fund, we put our members' interest at the forefront of everything we do. We have very clear roles and responsibilities for the board and the executive team, and the accountability that comes with that. The board and the executive team work constructively together with the right level of challenge from the board. The board made good progress in adopting the recommendations made by the Royal Commission, and as always, we are 100% focused on acting in the members' best interests. Our oversight has helped LGIA implementation of changes such as legislative changes that I talked about earlier, increased transparency around fees and costs, our commitment to servicing members in communities near and far, and keeping members informed with clear information. So our annual report, which you'll receive, and today's annual member meetings are all part of that commitment to communication with you. Now, a little bit about our board structure. So the trustee is governed by the Board of Directors of LGIA Super. The structure of the Board of Directors is best practice in the industry. That is a third member representatives, third employer representatives, and a third independent directors. Member and employer representatives are elected by our members and the LGAQ, so the Local Government Association of Queensland, respectively. Board's responsibilities include to review and approve the strategic direction of the fund, to monitor the implementation of that strategy by the executive team, and to govern the fund in accordance with the trustee, relevant legislation, and the prudential obligations that APRA require. So COVID-19 had some special requirements for governance during this time. LGI Super's team and systems were well prepared for a pandemic. The improvements we made across the fund equipped us well to respond. But very specific things we did as a board. So we held additional board meetings in the second half of the financial year to review and approve changes to manage the economic, financial, social and political impacts of the pandemic. And we had regular meetings with APRA, our regulatory authority, which was also crucial during this time because they were contemplating the sorts of changes that they could make to the legislation to help people financially impacted by COVID-19. The board had close oversight of the fund's implementation of the early release scheme, as I talked about earlier, and additional monitoring was applied to some major partners, our custodian, JP Morgan, our insurer, TAL, and of course Tech Mahindra. And to keep the fund's costs down during the early months of the global volatility and uncertainty, directors and executives all agreed to take a 10% reduction in remuneration for the last quarter of last financial year. As a profit to members fund, everything we do is designed to help members plan for and enjoy a comfortable retirement. It's what we're here for. Central to this is ensuring we're providing services in the most efficient way possible. And you can see some of the industry awards on the slide there. This year we were committed to cost savings with a range of operational and administration efficiencies, which are already enabling us to deliver improved services to members. We operate consistently with our core philosophy of putting members' interests at the forefront of everything we do. Growth and innovation has been a key priority this year, and continuous improvement is built into our fund, which Kate will take you through next. So please welcome our CEO, Kate Farrar.
Thanks so much, John, and good afternoon, members and guests. Thanks for attending our annual members' meeting. Well, as John said, it has been quite a year, both within the fund and also externally. When we started it, the last financial year was to have been about continuing our change journey, creating a better and more relevant fund for our members through improvements in member experience and process, as well as our investment program. This, of course, was interrupted by COVID-19, with its significant implications for the health, financial wellbeing and superannuation savings of our members and our staff. But through the disruption, I am proud of the innovation that the team has brought to providing better and more relevant services for you, our members, now and in the future. So some examples of the innovation are: we've reduced the cost of running the fund, which you, our members, will see from 1 November this year in the form of a large reduction in the weekly administration fee, so down from $1.50 to $1 per week, as well as some of our investment management fees. We've been making great progress with leveraging all of our new partnerships in administration and technology with Tech Mahindra, as John spoke of, investment management and insurance. We've digitally enhanced our member communications with improvements to usability, readability and accessibility across our various channels. And we've introduced a whole new range of channels and services for your convenience and interest, including webinars, which I hope you've been checking out, new online education resources, and our new Super Hub platform for council employees. Today, we're going to be giving you some further details about the innovations this year by the fund, and of course, we'll be welcoming any further questions you might have on these topics in the Q&A later on. Some of the great innovations that the LGIS Super team has delivered this year include introducing online video for our Super Health Check appointments, That's been incredibly popular with members. We've conducted nearly 4,000 super health checks over that financial year, which was a 32% increase on the previous financial year, with around a third of those conducted over the telephone or video. We moved all of our seminars online to webinars, although I'm really looking forward to getting back out there and speaking with people face to face, and it's so great to see you here today. Increasing the number of financial advice appointments by 20%, with 75% of all of our appointments for the year conducted over the telephone or by video. Launching super hubs into 10 councils, and it's 16 now, which is fantastic. Providing council employees with superannuation information and support within their workplace. As John said, we also spent a lot of time last year implementing significant changes required by government's new legislation, both post-Royal Commission but also post-COVID-19, and that last was at very short notice. We've also made some great improvements to our member online, which has resulted in a 54% increase in visits on the previous financial year to over 900,000. So I think you'll agree that that's a fantastic list, but amazingly, all of that had to be provided whilst we were changing the way we ourselves worked within the fund, so we could remain open and fully functional throughout the pandemic. This year, I really believe we've demonstrated that as a boutique fund, we have an advantage over some of the larger funds. We have the resilience and the adaptability to move with our changing world, minimising the impacts of that change on you, our members' experiences and outcomes. Because of COVID-19, the LGIS Super team was faced with a significant increase in the work you needed us to do to help ensure great retirement outcomes for you. Our investments team had to respond quickly and often to protect your savings and minimise the impact of volatility, which, as you have heard and will hear, they have done outstandingly. Our member services team handled over 66,000 calls, which was a staggering 23% increase on the previous financial year. We had over 2,000 meetings with employers, which were either in person or by phone or video, and we had over 7,000 members attending our workplace visits, up nearly 40% on last year. So given the team's performance, I wasn't surprised that the fund received external industry recognition. We received Super Ratings Platinum Award for the 12th year running. We got 5 apples from Chant West, as well as being ranked in the top 10 best performing funds for calendar 2019. We were finalists in the Chant West Connexus Financial Super Fund Awards for Member Services Best Fund and also for Super Fund of the Year. But in this fast-paced world of super, all funds need to keep changing just to remain competitive. For this reason, as John said, we're pursuing a merger with Energy Super. And I'd now like to give you some more details about that. Firstly, who is Energy Super? Energy Super is an $8 billion industry super fund with a long and proud tradition of serving nearly 50,000 members within the Queensland electricity industry. Energy Super stood out to our board as a great partner because we have more points of similarity with Energy Super than we do difference. For example, Energy Super has a heritage of more than 40 years as a specialist sector fund working with employees within its area, the government-owned electricity sector, just like we do with our 50-year local government heritage. Like our fund, Energy Super became an open fund in recent years, meaning that their membership is like ours. So it's a mix of specialist sector employees, government employees, and new members from a range of different industries. Also like us, Energy Super is a profit for member fund, not a fund that's trying to deliver profits to shareholders. This allows them, like us, to have the member at the heart of everything that they do. Energy Super is a Queensland fund that's headquartered in Brisbane but serves members across the state, delivering strong workplace engagement, education programs and assistance for members with their financial literacy. Importantly, Energy Super shares the same aspirations that we do, to achieve better scale so that we can remain a boutique and personalised fund, but all the while we can deliver an outstanding member experience, maximise member returns and keep costs low. Joining with Energy Super to create a 120,000 plus member fund with about $20 billion under management means we can spread costs over more members and access the advantages of scale to reduce fees even further. Early modelling suggests we could deliver something like a 10% improvement in fees overall for members, leaving more money in your account for your retirement. At the end of the current due diligence process, expected towards the end of this year, we'll be in a position to let you know whether the two boards have agreed to proceed further or not. Once we've reached that milestone, there would then be a period of around 6 months to finalise our transition ready for day one on 1 July 2021. I'd now like to address the top 3 questions that we've received so far from our members about this process, and I must say they're very good questions. So first of all, we've been asked about staffing and redundancies. As part of the Memorandum of Understanding, both sides agreed to a no redundancy policy that would extend 18 months from an in-principle agreement being reached, taking us to the end of June 2022. We've also agreed that all roles in the organisation, mine included, will be subject to a merit-based selection process from within our existing team members to determine where each individual sits in the organisational structure. And finally, this is really about delivering great services to you, so I would not expect there to be too much of an impact at the front line, so you can be confident on seeing friendly faces that you know, really good quality people, as always, into the future. Members have also asked whether there's planned to be a member vote to ratify the merger or not. The short answer to that is no, it's not required by the regulation. When an agreement is reached by both boards, we can undertake a successor fund transfer, which is the standard way that mergers take effect in the superannuation industry. Whilst we don't need a vote to ratify the merger, though, we can't change anything for you until after we've communicated with you first and given you plenty of time to think about it. Lastly, our members have asked about whether the name Energy Super means that the fund is heavily weighted in its investments towards oil, gas or other fossil fuels. The short answer is no. The name Energy Super reflects the fund's heritage and status as the fund for Queensland's electricity sector workers, including those from the distribution and transmission sectors who move renewable energy around, like Ergon Energy and Energex, and also many employee electricians. Energy Super also covers CleanCo, the Queensland Government's new renewable energy generator. Energy Super's investment profile covers many of the same areas and assets as our own, and the fund is very transparent about where its members' money goes. In fact, you can click on the investments area of the Energy Super website and download particulars of what assets are held in each of the portfolios. So they're the top 3 questions that we've received so far about Energy Super, but of course, if you have further questions, we'll be happy to take those in our Q&A section later, or to have a chat with any of you who are here after we conclude. So returning to LGIS Super business, LGIS Super regularly conducts research and other programs to listen to and better understand member needs and expectations. As a result of listening to our members, this year we implemented various enhancements to provide better experiences for you. For example, we launched a new online learning centre providing members with education videos and articles on a wide range of superannuation topics. We made enhancements to Member Online, making it even easier to manage, update and track the performance of your superannuation from either a desktop or a mobile device. We also increased the security of your data by introducing 2-factor authentication, which adds another layer of protection to processes like logging in, consolidating your super and, of course, withdrawing. Our digital newsletter is keeping members updated on all areas of the fund, tailored for different member demographics to be much more relevant to you. It's being sent out to over 55,000 members with the latest insights and updates to help all of you, our members, grow your superannuation. We also launched a new service to provide free advice on a series of topics, with the advice included in the cost of membership. Members have responded favourably to our efforts. Our Net Promoter Score, an assessment of our member sentiment, was 13, an 86% increase on the previous year. In the industry rankings for the assessment, we moved up 4 places this year to 9th overall, which is a fabulous achievement and bucks the trend across the industry. So can I say we're all very happy that you're happy with what we're trying to deliver for you. One of the things we've also done this year is advance significantly in our thinking about how we fit in for you throughout your whole life. We've started to think about LGI Super as your fund for life. We aim to serve and support our members by being there when you need us, and I think we've shown that this year as we responded to 2020's curved balls. During the upcoming year, we'll be developing this concept still further through the launching of our digital journeys, which enable us to leverage for you the commitment the fund has made to date in investing in technology. This is being done in partnership with our administration partner Tech Mahindra, and was a core part of why we made the decision to work with them to leverage their global digital expertise in a really cost-effective way. But of course, whilst we work very hard on your experiences, our main focus must always be on delivering great outcomes for you through the investment program. And there, we've done a significant amount of work to provide you with more transparency on where your money is invested and to focus on the assets we expect to perform in this volatile environment, with a further focus on lower fees and costs. As a result of the investment team's hard work last financial year, we're now in the position to make a range of changes to the investment program. From 1 November 2020, we're changing the structure of our asset classes and strategic asset allocations of our investment options. These changes include reducing investment fees for all diversified options and also some single asset class options. Introducing new asset classes to ensure that the purpose of those assets in your portfolio is really clear to you. Increasing investments in what we see as the asset classes for the post-COVID-19 era, including infrastructure, particularly in Queensland, private capital, which is a new high-growth asset class, diversified fixed interest and cash, where we're focusing on high-yielding sub-asset classes, and Australian shares for the franking credits. The transition costs to our new strategic asset allocations have increased indirect costs for 2019-20, as have the costs of volatility management through COVID-19. And these have already been factored into your returns for last financial year. We expect that the changes that we've already made to the portfolio will now start to reduce indirect costs in the near future. So this is an exciting package of changes that should make a real difference to your returns in the future and give you a clearer understanding of where your money is invested. Importantly, though, we're not taking our eye off the ball right now. Through it all, we remain confident that our diversified portfolio is well positioned to minimise the impacts of volatility and take advantage of opportunities as they start to arise. In addition to our great annual returns, in data released recently by independent ratings agency Super Ratings, our key diversified options were top 5 performers in their category for this financial year to date. The fund has also performed really strongly against competitors over 3, 5 and 10 years. So I'd like to close on this note. I'm really proud of their fund's performance and the way the team has responded innovatively to the changes driven by COVID-19. I'm very optimistic about the future of our fund as we face up to our continuously changing world. As always, though, we will continue to focus on delivering more for our members and the best possible retirement outcomes. Thank you all for your ongoing support of LGI Super and for coming today. I'd now like to welcome to the stage our Chief Investment Officer, Mr. Troy Rick, who will be discussing in more detail the fantastic investment performance that we've achieved for this year. Please welcome Troy. Thank you.
Good afternoon, everyone. I've prepared some slides here for us to talk to, but what I'd really like to do is to answer your questions. So whether it's via the microphone, or note, or online, please send them through. I look forward to talking with you about the portfolio and what we're doing. So the financial year began quite well. Share markets were rising. It was generally a buoyant time in financial markets. Despite the fact we had slowing economic growth around the world, central banks were supporting markets through reducing interest rates, and this helped to increase investor sentiment. We also saw an easing of those tensions in trade between the US and China with a Phase 1 deal. Certain promises were made, not all of those have been kept. What it did, though, was ease people's longer-term tensions around globalisation, which of course is really important for Australia. As you can see here, I'm looking at the S&P 500 chart. This is the stock market in the US. It's the world's largest stock market. That appreciation from September through to early February, that's about a 10% increase in share prices. So it was obviously a very good time. Unfortunately, as COVID-19 reared its ugly head, the impact on society and the economy as a whole, and therefore on financial markets, began to flow through very quickly. That drawdown you can see from peak to trough, that's a 35% fall in US shares. That's the largest and fastest fall we've seen in share markets in the last 100 years, with the exception of Black Monday in 1987. Right, there was a significant fall in anyone's language. Now, the good news, of course, is that markets have started to recover since that time period. We're still struggling with COVID-19, particularly in the US and Europe, but the bounce back we're seeing here in share prices is very welcome by investors. We saw a similar story here in Australia too. This is the ASX 200 index that we're looking at for last financial year, 2019-20. You can see that drawdown from late February to late March, about 35%, but we haven't recovered anywhere near as strongly. The Reserve Bank's been trying to support investor sentiment out there with further cuts in interest rates. We're now down to 0.25%. I expect them to cut rates on Tuesday down to 10 basis points. The government's been out there supporting the economy as well with 3 different fiscal stimulus packages totaling more than $200 billion. And that's in addition to all the state-based financial stimulus packages that go with it. They're obviously trying to cushion the blow from the financial hibernation that we're in as we deal with COVID-19. So given that turmoil, that uncertainty, how have things actually worked out for members? Well, I'm pleased to report to you that despite all that was going on in the world, we managed to eke out a positive unit price return in MySuper under 75 and a positive return, in fact, for all of our diversified options. So for all the legal eagles in the room, I do have to make that disclosure. The unit price return captures all investment fees and taxes and the 18 basis points administration fee, but these returns are before that $1.50 per week is taken out of your account. That blue bar you see there on the left-hand side, that's the median fund in the Super Ratings survey for last financial year. The small green bar there, I know it's hard to see, that's us. No one likes losing money. I'm happy to report that we generated a positive return there on the unit prices and certainly was well above the median for last financial year, but also above median for 3- and 5-year returns in MySuper under 75 as well. We know that's important for some members who like to compare us against other funds. The good news we've seen since that recovery in late March through to June this year has continued on in the first quarter of the new financial year 2021. So at 30 September 2020, we're again looking at peer relative returns here. The green bar there on the left-hand side, that's MySuper under 75. We're strongly outperforming the median fund. In fact, we're the number 2 fund in the country for financial year to date. You can see over 3 and 5 years, we're also doing very well. We're top quartile returns. And we know that's important. Members need to have confidence that the fund's doing the right thing for them. And I'm pleased to report to you that our returns are as good as anyone else going around. We're talking about relatively short-term time frames here, 1 year, 3 years, even 5 years. The best performing asset classes last year were an interesting mix of, the international share market, but also the global bond market, 2 quite opposite types of assets. But it's important to put this stuff into a longer-term perspective. I was speaking to one of the members who's been in the fund since 1989 previously. So I want to talk about our default strategy and a 35-year history of delivering 8.8% per annum after fees and taxes. Are people familiar with the rule of 72? Noel Whittaker talks about this one sometimes. That 8.8%, let's round it up to 9% per annum. That means you're doubling your account balance every 8 years. So over a 40-year working lifespan, that means you get to double your account balance 1, 2, 3, 4, 5 times. That's compounding wealth. That's why these returns are so important. We know that members need to build their retirement balances. That's why we're in this game for the long term. We do want to build a long-term investment strategy. That's the best possible way we can help you to build those retirement balances. And so why is it important to keep this long-term perspective? We're in the middle of COVID-19. It's incredibly distracting. It's incredibly destructive to our economy, our society, and to our financial market returns. Well, the reason you need to keep this in a longer-term perspective is, you see that green line there? That's the last 35 years. I joined financial markets in 1995, just in time for the Asian financial crisis. And then the collapse of LTCM and the Russia default, the technology boom and bust, the commodities super cycle, the global financial crisis, the European sovereign debt crisis, the China growth scare, and now COVID-19. We have one of these great big financial crises about every 2 or 3 years around the world. They're an unfortunate feature of the system. They are, as you know, incredibly distracting while they're going on. They draw your attention to the very short term, and it's entirely reasonable that people think about making short-term reactions to those events. The challenge is, of course, that when you look at that green line, despite all that's gone on in the last 35 years, the green line goes up in the long term. Time in the market rather than timing the market is almost certainly going to be the biggest influence on your retirement balance outcomes. My job running the investment program at LGIA Super is to help navigate these crises as they come up and make sure that you can stay invested for the long term. Because if you can't invest through those bad times, you're never able to capture the full benefit of the good times. That's our core job here. So let's talk about some of the assets that underlie that investment program. We will talk about the international investment program in a moment, but I do want to talk about some of the stuff we do here in Queensland. We're very interested in buying financially successful businesses located here at home. We're always interested in doing well by doing good, and if we can do it locally as well, that's an attractive investment thesis. What we're looking at here is the land that underlies 2 of the theme parks on the Gold Coast, which are managed by Village Roadshow. This is all public information. We've got a 30-year lease here. It's a 6% per annum yield, growing at 3% per annum, triple net. That's fantastic. A really simple asset that generates income. It's an increasing feature of the investment program here. We want to build out a program with sustainable income generation. We think that future capital returns across the asset markets are going to be tougher to generate, so building sustainable income, generating money today and tomorrow and the next day that grows over time, continues to beat inflation, is going to be an increasing focus for us. One of the reasons I like this investment is it has multiple uses. In a worst-case scenario, when Village Roadshow wanted to close up and move the theme parks on, we'll take possession of the land back, and I'm sure there's big residential property developers out there who'd love to help us turn it into some housing developments. It is a key part of the investment strategy to think about risk in multiple forms. I mentioned the international program. It's a really important part of what we do, that we invest as much money as possible and efficiently as possible into the international program. There are simply some asset classes and opportunities that we can't capture here in Australia. I've featured 3 infrastructure assets here on the slides. We do think, as Kate says, that infrastructure is an attractive asset class. We like those stable long-term cash flow distributions. We like the fact that the discount rates are still quite high, particularly compared to bonds and real estate. There's a sense of stability about it. And of course, the real assets, right? We all like to be able to go and see things and touch things. The asset we're looking at here on the left-hand side is one of the assets in the Controlled Environment Foods Fund. This is a group that's building greenhouses and leasing them out. All right, that sounds like a pretty boring investment. I like that though. There's a key aspect to this investment I also build on, which is food security and food safety. Right? Having been to this facility in the US, Revol Greens is in Minnesota. If you've been to Minnesota in November, you know it's pretty cold. There was 2 feet of snow on the ground. In the greenhouse though, it's a crisp 22 degrees and 95% humidity, so that was t-shirt and shorts weather. This is 2.5 acres of lettuce. We're currently expanding that facility to 10 acres of lettuce, on the way to 22.5 acres of lettuce. And I think that's more uses of the word lettuce than I've otherwise used in my entire life. I can just tell you it's a lot of lettuce to go and have a look at. The reason this stuff works so well is that for a supermarket retailer like Walmart, who's trying to compete with Amazon in terms of their groceries and deliveries, fresh food is their key aspect. They want to draw people into the stores, and fresh food produce is one way to do that. Walmart can sign up a long-term deal with this group of controlled environment foods for things like lettuce and know that, A, food security is guaranteed. The lettuce are grown 24 hours a day, 7 days a week, indoors, away from the weather. So even in Minnesota, you can get crisp green lettuce. An even bigger aspect, though, is food safety. There is occasional outbreaks in the US of salmonella in romaine lettuce, which causes supermarkets to pull all the lettuce off the shelves. We can have fresh, safe lettuce back on the supermarket shelves within 24 hours from this facility in Minnesota. So food safety and food security are huge issues going forward. The other thing I like about this one is resource usage. Growing lettuce indoor like this uses 90% less power, water and fertiliser than they would in an equivalent outdoor facility. It ticks a lot of boxes for us. The other two assets I've got on the screen here are power generation and distribution companies. One is Inkia Energy. This one's based in South America. And the other one here is Grupo T Solar, which does have a number of renewable energy sites around the world, but particularly in Spain. Renewable energy is a growing sector for the fund. We do like, again, that stable, predictable cash flows that come from take-or-pay contracts. And of course, there are a number of ESG aspects to this we also find attractive. We're talking about asset classes. So how did we go last year in terms of those asset classes? We eked out a small positive return for infrastructure. Now, given the recession we've just seen, we think that's actually a pretty good outcome. The infrastructure portfolio is well positioned for future years. International shares we've also discussed. We've got a nice positive return there, including a little boost from the foreign currency we hold on that portfolio. And it allowed us to eke out a return that almost equivocated to that we got from our bond portfolio. So those two assets we see there on the right-hand side of the screen, cash and bonds, they're more defensively oriented parts of the portfolio. We have them there to generate liquidity in times of stress so that members can get their money, but they also provide positive returns when other assets tend to provide negative returns. So we're trying to diversify amongst the risk profile. The real challenge, as I'm sure you know, is that those assets now generate very low long-term expected returns. The Reserve Bank's currently given 25 basis points per annum. If you go and make a term deposit here, you'd be flat out getting to 1% per annum, even for a 5-year TD. Government bond yields are even lower. 10-year Australian government bond yields now yield less than 80 basis points per annum for the next decade. Now that's less than what we think the rate of inflation is, and that's before fees and taxes. They're really challenging assets for a long-term investor. We strongly prefer infrastructure to property in the current environment. Property returns here were negative, unfortunately, for last financial year. Again, I don't need to tell you if you've been through a shopping centre lately, there are some challenged assets in the retail space. We do spread our money around within the retail sector and also between retail and industrial and office, but property is a challenged asset class. The prospects there just aren't as good as for other asset classes at the present time. Kate mentioned to you how important we think being competitive with other funds is. And that's not because it satisfies our egos or makes our socks roll up and down. What it does is give members a sense that we are not just doing the right thing, but we're doing at least as well as other funds out there. It's really important to us because we know that members have a choice. They don't have to invest with us. So we certainly want to do the right thing by you, and our goal is always going to be to help you build that retirement balance and then help it to spend it in retirement itself. But we know you have a choice. And so being competitive with other funds is not about our egos, it's about making sure you know you're doing as well as anybody out there. And I'm very pleased to report to you that LGIA super returns are top quartile over 1, 3 and 5 years. When you invest with us, you're investing with one of the leading super funds going around. Good investing is good risk management. When you make an investment, you're not just looking to try and make an assessment of the expected returns, you're also trying to understand the expected risks that go with that investment and the potential range of outcomes under different scenarios. When thinking about those potential risks and the different scenario outcomes, environmental, social and governance considerations are an important part of that. There's a lot of work done in the industry around listed shares in particular, but one of the examples I want to use for you today happens in the infrastructure portfolio. We've just purchased another part of the Sunshine Coast Airport. We're very happy to do so. We think it's got great long-term prospects. The Sunshine Coast has just been through a renovation program on its runway. Right? That's a 35 to 50-year investment program for them. So a key part of the consideration for us in thinking about that long-term investment and making sure we have the revenues to pay it back over time is that subtle long-term risks, like ESG, become much more important. I want to know, for example, that if we do see rising temperatures around the world, that the water table which underlies the airport is not going to rise to such an extent that runway is going to be damaged. And I think that real assets portfolio, infrastructure and real estate in particular, are a greater example where some of these longer term risks, more subtle risks, become more important. Right? ESG is always going to be part of our risk assessment. It's not the only thing we do. It's not necessarily the most important thing we do, but it's absolutely an essential part of the program going forward. And I don't need to tell you, regulators are placing greater emphasis upon this, and we're certainly having more in-depth conversation with the membership around these issues. Let's look forward, not look back. It is a fairly challenging time. COVID-19 is still here. I hope this is not an issue for us in the long term. But again, we've never actually had a virus like coronavirus before with a vaccine attached, and that's the key aspect to a long-term recovery. I hold good faith that we'll have a vaccine soon, if not tomorrow. And the sooner we get that vaccine out and we can just manufacture and distribute it, the better it is, of course, for our society and our economy, but it's also good for financial markets. When people can have greater confidence about the future, they're more likely to invest, and businesses in particular are more likely to hire. Consumers are more likely to spend. The more that life comes back to normal, the more that our economy will come back to normal. So I'm hoping within 6 to 18 months, this is much less of an issue to talk about. But there are still long-term challenges out there for us to think about. What we're looking at here is the price-to-earnings ratio on some of the share markets around the world. That sounds like a complicated thing. What we're looking at here is the price you pay for $1 of future profits. Right, and I'm looking here at the light blue line in particular, which is the S&P 500, the US share market, 22.5 times next year's profits. Right? Compare that to 10 years ago when it was more like 11 times. What does that actually mean in practice? Well, it's like a seesaw. The higher the value you pay for a future year's profit, the lower, all else being equal, future expected returns are. So this massive escalation we've seen in price-to-earnings ratios is going to lower future expected returns from share markets. You already know that cash and bonds are challenged assets from long-term expected returns. So for traditional assets like cash, bonds and shares, we're finding it harder and harder to raise those expected returns from traditional investments. So a key part of the asset restructuring that Kate highlighted here is how we're going to deal with that returns challenge. Because I know that members can't deal with lower returns in the long term. You're still going to need to compound your wealth up to have a reasonable retirement balance. The key part of the investment program here that we're working on is finding sensible ways to deal with that long-term challenge. So as part of that challenge, we do two things. We build an investment strategy here that is deliberately growth-oriented. If I invested most of your money into cash and bonds, we're not going to be able to keep up with the rate of inflation over time, and that's before fees and taxes. So we are deliberately investing large parts of that default strategy and then varying parts from defensive all the way through to aggressive into growth-oriented assets. Number two, we pair that with a long-term time frame. Right? It's an absolutely essential thing that we take that long-term time frame. I talked about the financial crises that turned up every 2 or 3 years. And then number three, what sort of risk management do we put around that? Well, part of this is about spreading the money around. We're looking for genuinely differentiated sources of return, different return drivers. So we want to differentiate and diversify between geographies, between asset classes, between investment styles and managers. We're looking to find that optimal mix of risk and return across the portfolio that'll help maintain those expected returns to be as high as they reasonably can be. I've highlighted some of these assets already. Folks who've seen the annual report from last year may be familiar with the Sloan Club. We've also increased our investment in agriculture and timber in the last couple of years. Right? So we now own a chunk of a teak plantation in Brazil through Folium Agriculture and Timber. And that's obviously interesting because we do pair that international investment with investing here at home where it makes sense to do so. Folium's just bought into an avocado farm in North Queensland. That suits me personally. I like a good piece of smashed avocado on the sourdough on the weekends. We've talked about Village Roadshow in the theme park land, the Gold Coast Light Rail, the Sunshine Coast Airport, and the Regional Livestock Exchange. We do still very much want to buy financially successful assets here in Queensland. Right? Doing well by doing good and doing it locally still makes a lot of sense. But that diversification aspect, right? We still think that it's the most important part of the risk management strategy. We're looking to spread your money around sensibly because we know that we still need to invest for the long term and we still need to generate those good returns so you can live the retirement that you want to live. I'm looking forward to taking your questions. Can I say thank you very much for your time this afternoon, and it's an absolute pleasure to be talking to real people again rather than to a television screen. Thanks, everyone.
Thank you very much, Troy. And we are now into your part of the day. Here in the venue in Brisbane, we have an overflow room. I think, in fact, Kedron actually had some flooding, didn't it, this week with the Brisbane storm? So I should probably come up with a different form of words to describe that. But we have an overflow room upstairs, and of course, you watching the webinar at home or at work elsewhere. So wonderful to have you with us. And it's, I think, the way of the future that we'll have to be doing these things in person and online, and no doubt there'll be other ways as well in the future. So we'll open to the floor in a moment with a reminder that you have John, Kate and Troy available to answer your questions. Please note, though, that we won't be able to address questions regarding individual accounts, personal financial matters, sensitive matters or grievances. But if you have a question that's more personal in nature, I'd encourage you to visit our specialists, of course, and to speak with them. They're here in the room here in Brisbane. Time's limited today, and I apologise if we don't get to everybody's questions in the time allowed. We'll aim to answer one question per member, but if we can't respond to your question within the sort of 2 or 3 minute time limit, then we'll follow up with you personally at the end of the meeting, so everybody hopefully gets a fair go. For those joining us online, please submit your questions using the blue hand button at the top right of your screen, and we'll make sure we get to your questions, of course. So is there someone here in the room who would like to ask the first question? Thank you very much. Over to the side here, the gentleman I saw at the hairdresser this morning.
Thank you, Tim. To probably the chair of the board, I'm very pleased. I'm from Dalby, and we're nearly Western Queensland, not quite. But our council out there has about 700 employees. There's I think, a really good synergy with the Energy Super, because there's many hundreds of energy employees in our area with Ergon, Powerlink and CS Energy and CleanCo just making some new investments in our area as well. But I was keen to find out what you think the timeline on knowing whether or not that merger is going to go ahead might be, and if it doesn't go ahead, would you look for another partner as well?
So yeah, the time frame that we're working towards at the moment, and very much on track to that time frame, is to aim to sign a binding heads of agreement by December, so probably towards the end of December, with a plan to transition by 30 June next year. Everything I see before me today suggests that that's exactly what we're going to do. The two teams from each board are working really well together. The two CEOs are working fantastically together. And we now have people within each of the businesses looking at their responsibilities. So if it didn't go ahead, that would be really, really disappointing, because I felt like there's a likeness to our thinking, a likeness to be really focused on our members, the way we provide services. It's all very, very consistent. It's almost a marriage design for us. If it didn't go ahead, we did actually contact 7 other funds or thereabouts. So we did do an assessment across the industry. Energy was well out in front in terms of who we would choose. But there are others. We have spoken to other funds. One of the key things we put as a requirement for this merger, and any merger, was to leverage the Tech Mahindra partnership. It's extremely important to us, but we also think it's the best facility that a fund can have to actually deliver services effectively, cost effectively, but also to develop them going forward. So in a digital sense, they're really, really advanced. So we thought it's almost like the jewel in the crown. We're not going to let it go, and we'd love to stretch it across more members. So look, at this stage, I think it'll go ahead.
Thanks, John. Ross, thanks for your question. Kate, do you have any questions from the webinar at this stage?
Yes, thank you, Tim. I do have one question from the webinar, which is for Troy, actually. How does LGI Super set targets for your investments, and how do you assess how you've performed?
Well, that's an excellent question. What we're trying to do here is build an investment program that gives members choices. So we build these diversified options that have various levels of risk, as well as the single sector options. So the return targets on those are deliberately set that, for example, in My Super Under 75, we're trying to give you a real return after fees, taxes and inflation of 3% per annum in the long term. Aggressive has a higher target, balanced, stable and defensive have lower targets than that. And the maths behind that is about replacement of income in retirement. We then measure ourselves over time on those outcomes. We're also trying to take into account current market conditions. So as Kate spoke about before, we will change those allocations to try and maintain those expected return targets over time. And then we benchmark ourselves both against that target, peers, and what we call an internal SAA benchmark.
Thanks, Troy. Can I urge you again, if you are with us online, to please use the blue hand button on the top right of your screen there to ask your question, so you're part of what's taking place here. We have some pre-submitted questions as well, Kate, and there's one here that perhaps you can take care of to get us underway. And the question is a pretty simple one. When will we have our annual statements for the previous financial year?
Thanks very much. Great question. And it's fantastic to be able to give this answer, actually. So all of the pension and accumulation statements have already been dispatched, and we are now in the process of dispatching the defined benefit statements. If you want to talk about those statements and you're here in the room, we have our Chief Operating Officer, Eleanor Noonan, waving her hand, and she'd be glad to talk to you about that. But wonderful performance this year. Thanks, Eleanor.
Thank you very much. In the room here, yes, good afternoon to you.
Hello. I've been reading a lot lately about the high potential returns from investing in renewable infrastructure, solar, wind, batteries, etc., because my understanding is that we're reaching a tipping point in how fast that's going to grow. So first question is, I'd like to know which of the funds in LGIA would I invest in to get some of that action? And my second question is, I noticed that you have a solar energy farm in Spain, but are you looking to invest in any solar, wind or battery or transmission infrastructure in Queensland?
Both of which are excellent questions. So if you want a slice of the action, I always like that terminology. The infrastructure asset class contains all of our renewable infrastructure. We feature Waterloo wind farms there on the slide behind you. We've talked about T Grupo Solar. So all of the diversified options, defensive, stable, balanced, diversified growth, aggressive and My Super, all contain some infrastructure. The prospects for infrastructure investments in renewables in Australia, we do find that quite interesting as well. One of the great challenges we've had in Queensland is transmission of power from remote Queensland in particular. Marginal loss factors have recently been increased. So I'm hoping that we can solve some of those transmission issues quite quickly, in which case renewable power becomes a more attractive investment proposition too.
Thank you for your question. Kate, do you have something for us there?
I do. I have a question from Dean, and I'm going to give this to you, John. If a merger proceeds, it would be very difficult to choose which CEO, which board members, etc., take on the new roles. So who oversees that process?
Good question. And the two chairs have been discussing how the process would be undertaken. Kate covered this a little bit in her presentation. So the first thing is it's very much a merit-based approach. So from the first process would be to determine the best CEO. And that really sets the tone for how we make the decisions right across the organisation. So we will set up a process for determining who will be the best CEO. We'll be looking for that CEO to present their vision for the joint business to us, and we're looking at their credentials to actually deliver on that promise. Obviously, there's a lot more detail that will go into our assessment, but that's to give you a flavour as to what we do. Once we've selected the CEO and the board and the Joint Steering Committee will be involved in selecting the structure of the organisation and then the positions to fill. But as Kate said, we also guarantee no redundancy. So if a person is challenging for a position and doesn't receive that position, they will be retained by the business. It may well be we have a better opportunity for them. And as we said, the front line of the business is very likely not to change. If anything, we will supplement it to improve the service. From the board's point of view, we will have a transitional board for 18 months post 30 June. That transitional board will contain the 9 members of our board and 6 members of Energy Super, representing the sort of proportionate sizes of each of the businesses. And that 15-person board will then go back to 9 in 18 months' time.
Thank you very much for that question. Another pre-submitted question from John. I understand that the super daily returns are pegged to the share market and other investments. However, when there appears to be a very good day on the share market, it oftentimes appears that the super return, which appears 2 working days later, does not appear to fully reflect the share market return. Can you enlighten me as to what algorithm is used to calculate super returns? Thank you, says John. Kate, Troy?
I'll take that one, thanks, Tim. That is a really good question, and I'll hopefully explain that in under 2 minutes. There's 2 important things for members to think about when they're looking at those earnings rates that appear on the website. One is that there's a 1 business day lag between what you see happen in share markets, in bond markets and currency markets, and what you'll see published on the website. The second thing is to know that share markets are an obviously large part of our investment program, but they're not the only thing that's in the investment program. If I take an option like Balanced, for example, only 30% of that investment is in shares. So the influence that has on the portfolio can be swamped from time to time by a really good return in bond markets or a big movement in the exchange rate. So starting from the top end with aggressive, that's mostly shares. Diversified growth contains 50%, 30, 20, down to 7. So just keep in mind that there is a 1-day lag between the returns you see in the market and those earnings rates on the website, which is sort of 7:30 at night. Number 2 is not everything you invest into is 100% in shares. So it's not always going to be a 1-for-1 change between what you see in the share market and what you see in the unit prices. Happy to talk about that in detail later on.
Thank you very much. We've got a question over here. Yes, sir, good afternoon.
Thanks. Do you envisage any further significant changes in the government's policy or regulations on superannuation, particularly as we try and get the economy moving again? We've already seen some responses, I suppose, in superannuation to the COVID crisis.
So I'll let Kate have a go at some of this. But on a high level, about 30 chairs got together for a get-together with Jane Hume, who's the senator that's responsible for super, and Stephen Jones, who's the shadow, to talk about policy and where they're heading. There seems to be a lot of discussion around the 12%. Now, I know that doesn't have a large impact necessarily on most of our members who have different contribution rates to the 9.5 that's currently there. So I think there is a lot of discussion around the 9.5 and whether we will go to 12. The budget also contained quite a significant number of announcements, and maybe, Kate, you might want to just tap on a few of those.
Yes, it's an enormous period of change for the superannuation industry. A lot of it actually arising out of the Productivity Commission and Royal Commission reviews, which have been worked through rather rapidly, actually, particularly given the COVID-19 environment. The biggest announcement by far, actually, that was in the budget this year was to do with the way default funds are allocated to members. And there were 2 announcements within that. The first one was that your fund that you start your working life with would follow you throughout your career. Doesn't matter if you change industry, doesn't matter if you change employer. So that's a significant change from now, where there are embedded in EBAs, for example, there are default funds so that every time you change your job, you can start another fund. So that one's obviously aimed at trying to reduce the number of multiple accounts that members have, been a big focus for the government this year. I guess the other aspect of the default fund piece was that last year APRA released a performance monitoring system called its heat map, and the government has extended that heat map performance into a legislative process whereby if you underperform on the heat map for 2 years in a row, you won't be able to take on any new members. So that was a very, very significant stepping up, I guess, of the remit of APRA's performance monitoring system. So they have already, or they've been flagged, they haven't gone into legislation yet, but those 2 pieces are very big changes to the structure of the superannuation system. There's also quite a lot of talk about insurance and the place of insurance and the role of insurance, so that there may be some change to the way insurance is operated within superannuation. But I think it's fair to say that we would expect that the regulatory environment would continue to change for superannuation, certainly for the foreseeable future. And of course, we'll respond to that.
Thanks very much, Kate. I know you've got a question there, but just before you go to that, a question pre-submitted from Greg asks, how much is this meeting and the catering costing members, please?
Thank you very much. Very good question. We do really focus, as you've heard today, on keeping costs low so we can reduce your costs. So it's costing about 4 cents per member per day to put this on, which we think is a really important investment actually in our communication with you. We are required by law to hold these annual members meetings, and it's a fantastic opportunity not only for the exec team who are here to meet with you and for you to talk with our growth specialists and our advisors who are here, but also just for us to really remember exactly what it is that we are doing here. I think Troy said, with a big smile on his face, that he was incredibly glad to be talking to real people and not actually a screen.
Yep.
I can't tell you how great it is for us to really be anchored back into our purpose of working with you, our members.
Thanks, Kate. And can I remind you, if you're watching online, please to get a question in using the blue hand button on the right-hand side of your screen. We've got about 20 minutes to go, and I'd really hate you to miss out. So please, if you have a question online, please make sure you ask that. I think you've got one, Kate?
I do indeed, and it's another one for Troy. So this is from Dean. Are the international investments that you spoke about in TIC or lettuce, a lot of lettuce, limited to any particular fund or across all of them?
Yeah, we think that international investment program is important for everything that we do. So with the exception of cash and Australian shares, we invest part of every asset class into the global portfolio. So infrastructure, in real estate, for example, we have some value-add funds based in the UK and Europe. Global shares is obviously a large part of the portfolio, and most of our alternatives have been internationally based as well. Mixture of Australian bonds and global bonds. So I think it's really important that every member who's invested into those diversified options, or even most of the single sector options, should know they're invested in that global program to one extent or another.
Thanks, Troy. To the gentleman down here. Yes, sir. Good afternoon.
Good afternoon. COVID-19 has affected not just Australia but right across the world. I'm curious to know what percentage of your members are affected by COVID-19, i.e. whether they're part-time, casual or full-time, whether their jobs are affected, and secondly, is there anything the union can do to assist those members?
Yes, thank you. That's a marvellous question. So the first point is to discuss early release. There was obviously the early release scheme, which was put in place by the government very quickly in order to allow members who are affected by COVID-19 job losses and income reductions to withdraw money from their super. So we had around 15% of our members actually accessing that early release. And that was sort of 1% or thereabouts of our funds under management. So it certainly wasn't really significant for us in terms of funds under management as a fund, but certainly that is a lot of members. I guess the hypothesis we draw from that is that a number of our members have been impacted by COVID-19. And in terms of support for that, obviously one of the things that John has spoken about that we did was to take a reduction in our cost base and our earnings. Did you want to talk about that?
Yeah, so at the time we certainly discussed as a board what we should do in terms of understanding the circumstances a lot of our members were in. We certainly were getting the feedback that many were being affected. We thought we understood that local government sector was really quite a resilient sector and almost very stable. So the level of impact was actually much more than we thought. And so the board did contemplate taking a reduction in remuneration around that time. I can confirm for you that the CEO also offered the same thing for us, and then shortly thereafter the executive leadership team followed. We did actually talk about extending it as a board. The difficulty for us was we didn't want the executive team to follow us. because they were working so damn hard. We were just putting them under so much pressure, we just didn't see the point in actually taking it any further with them. So we're very pleased to align with the people that were struggling at the time, but we have to get back on and do the job, and we really are thankful for the team to continue to do the really hard work that's required. And it's not going to get any easier as we head into a merger. So it's a lot of hard work required to do that as well.
Thanks, John. Thanks, Kate. Another pre-submitted question from Wendy. I noticed the Australian Super International shares FYI for last year were 11.46 and LGIA Super International shares were 3.44. That's a big difference. What are the strategies for this year to compete with that? That would be you, Troy.
That would be me. Wendy, thank you for your question. I can't speak to the risks that Australian Super is taking to generate those returns. What I can speak to is what we're doing here at LGIA Super. So I've pulled out the survey as at 30 September, and our international shares option has generated 6.8% per annum over the last year. That's 14th out of 50. 9.1 over 3 years, that's 19th out of 50, and 9.9% per annum over 5 years, that's 12th out of 50. So, that's top quartile, second quartile returns over 1, 3 and 5 years. We're pretty happy with that, to be honest. We're pretty happy.
Thank you. Kate, what have you got there?
Right, I've got a question from James. Was there any specific factors that saw LGIA Super change life insurers from OnePath to TAL? I'll take that one myself. So we ran a pretty rigorous process, tender process, and that included OnePath, TAL and one other insurer. And we looked at pricing, obviously, and in fact, if you have a look at the comparison of costs per unit of LGIA Super's pricing at present, it's really excellent. And we also, though, looked at the services offered to members and claims experience of the new insurers. And TAL, I have to say, was by far and away the preferred choice. And they have not disappointed us. They have been an absolutely fantastic partner for us. We've now completed our first year with them. In fact, the board is doing a first year review, I think, at our next board meeting. And really, they've been outstanding partners, both from a service perspective and also in terms of claims for members and delivering great value.
Kate, just while you've got the floor there, can I ask a question that's come through pre-submitted? Will executives be receiving bonuses during the COVID-19 pandemic?
That's a question for me.
I beg your pardon.
And the answer is no. We don't pay bonuses. We pay... Our remuneration structure is based on getting the best advice we can to provide the right remuneration to attract and retain people. We have some flexibility within that to pay at market, above market for high performers, so rewarding people who perform well, but we don't pay bonuses.
Thanks, John. If you have a question here in the room, please put your hand up and we'll get to you in just a moment. If you have a question online, please make sure you are getting that through now using the blue hand button on the right-hand side of your screen. Kate, I think you've got one there.
Yes, I do. Fantastic question. I love these questions that are coming through. They're just awesome. So this one's from Dean. What strategy do we have to ensure that newer local government employees swap onto LGIA Super from their existing fund? That is a brilliant question, because one of the big strategy moves that we've got for the current financial year is actually to slightly reorient away from retaining existing members, which is still obviously very important, but also to focusing very much more on making sure that we get our full share of local government employees. One of the key things that we have done to ensure that we get that is obviously the introduction of Superhub. I mentioned earlier that we have 16 councils with Superhub now, and that is a digital portal that comes up through the intranet on each one of those councils' intranets. That's a fantastic way to ensure that new people are able to access information about LGIA Super. Of course, what we're also doing, what our wonderful growth and relationships teams are doing when they're on site, and we are starting to go back on site to local government, what they're doing now is making sure that, when they're in a region or in a council, that they see not just existing members, but also potential new members. And we're also working very closely with HR and payroll teams to make sure we get into inductions. So the team are very focused on making sure that we are the best local government fund that we can be, and making sure that we have really good penetration there.
Troy, can I give you a couple of quick ones from the pre-submitted questions? From Bruce, where do you see diversified fixed interest being at the end of the financial year?
Good question, Bruce. I don't have a view for the next 2.5 months, but I know from a long-term perspective that fixed interest is a really challenged asset class. We're only really hanging on to it now for liquidity and that cushioning effect. I can't give you personal advice. I'm not licensed to do so. I'd encourage you to get a super health check if you're interested in your own account balance. But it's a challenging time to go out and buy bonds when they yield less than 0.8% per annum for the next 10 years.
And from Michael, when is an investment option centred around commodities going to be offered?
No current plans to offer an option around commodities for 2 reasons. One is that it costs money to set it up, and I think this is only the second member in my 12 months who's asked about commodities. Number 2 is, you can see from our choices online, the vast majority of the money actually sits in the diversified options. So we do think that a diversified options program is the way for almost all members to go. We do offer some single sector options there for members or who want to build their own portfolios or their advisors who want to do so. But commodities is not currently on the program.
Thank you. Kate, over to you.
Okay, another great question from Saji. This one's for you, Troy. Last I checked, you can invest in infrastructure as a single asset class. Has that changed?
You can't invest in infrastructure as a single asset class. Again, it's one of those we do occasionally get responses from members about. Property is a separate asset class that members can invest directly into. For the present time, given the discussions around the SFT, we're not planning to change the lineup of our options. I personally like infrastructure.
Thank you very much. From Glenn, why do we not have a local representative in North Queensland anymore?
Yeah, I'll take that one. Thank you very much. So I mentioned earlier when I was speaking about the Energy Super potential merger that LGI Super is more heavily weighted towards southeast Queensland than northern Queensland. The closure of our North Queensland office was a reflection of that fact. We needed to make sure that we were applying our resources in the places where people were. One of the wonderful potential benefits of a merger with Energy Super is that we would have together a really well spread portfolio of members across all of Queensland, so not quite so centred in southeast Queensland. And they do have services outside of Brisbane, which are, they're living there, they're domiciled in those areas. And my expectation is that we would be able to leverage those services for the benefits of members outside Queensland as well. So that is definitely one of the things that we have been looking at to make us quite excited about the potential of the Energy Super merger.
Thank you. From Laszlo, another pre-submitted question. What areas and in what companies is the fund invested in? We've had a little sense of that from you, Troy, already in your presentation, but where can Laszlo get perhaps a bit more detail on that?
Good question, Laszlo. For those who are more interested in more of the details, we do put some of our top holdings on the website. I think we're invested in something like 2,000 individual investments at the present time for the diversified options. So I could list them all out for you, but it would take me all day.
Kate, I think you've got one just through there, please.
Yes, I do. It's a question from John. Any idea when the government will release the results from the retirement income review? No?
No.
Sorry, they won't tell us.
No, there's around 600 pages in the report. There must be some things and coordinating things at the right time to be able to release it. So, no, we haven't heard any more. We'd love to see it so that we can actually get our teeth into it. We simply don't know. So sorry, we can't help you.
Okay. Robin asks, what changes, if any, has LGIA Super made in its share investment placements since the Rio Tinto destruction of Aboriginal ancient sites, and which current options for members are free of Rio Tinto shares? That's a question I think you would have been anticipating.
Yes, very much so. We've made no changes to our portfolio, and I want to talk about that one. The approach that we take here with respect to issues like the Juukan Caves destruction and Rio Tinto is we're very much in favour of engagement rather than divestiture. And it's a simple reasoning behind that. If you're a shareholder, you have influence over the board and the investment strategy and over the staffing, particularly the executive levels. If you're not a shareholder, you have no influence. So we could easily sell our shares, but we'd be getting rid of what we think is a long-term winner in the portfolio, and we'd have absolutely no say over their behaviour. You can see the impact that engagement from the investor base has made in the last 2 months on this particular issue. It's led to the termination of the CEO and 2 of the executives. And again, I'm a big advocate for engagement rather than divestiture for exactly this reason. The only way you can change people's behaviour is continued advocacy and engagement with those companies, particularly at the chair's level, and a collective voice amplifies that. In terms of the options that don't invest into Rio Tinto, members who invest in cash, diversified fixed income and property, there's zero exposure in there. We have about 2.5% in the Australian equities option and a very small holding in the international equities option. So it's really a proportionality thing for us. We think it's a more nuanced conversation than 0 or 1. So we're not black and white thinkers about these issues.
Thanks, Troy. For our friends watching online, we've only got a couple of minutes left, so if you have a question to ask, now's your opportunity to do that. And if you have a question here in the room, then pop your hand up as this gentleman here has just done, and we'll get to you straight away. So good afternoon.
Hi, my name's Robert. Look, it's probably a question for Troy. Troy, you seem to infer that, like shares and fixed interest income's likely to, like we know that the current interest rates are very low and like to continue to be low for quite some time. And also you said the PE, the price to earnings ratios of the share market's quite high, so you don't expect there's going to be great performance there around the world. Probably will. I know you haven't got a magic wand you can't see in the future, but so with this diversified growth you're talking about solar farms, you're talking about things that are likely to expand overseas, like you're talking about hydroponic farming in the United States, food and so on. You've got a thing called the MySuper Life Cycle option, MySuper Lifestyle under 75, which is not available to the defined members. I used to be in the diversified growth, which actually was a bit risky, I suppose. I stayed in it for quite a long time and it performed very well. Is the old diversified growth in the MySuper Lifestyle under 75 funds, are they similar? I know I haven't got the asset classes they invest in, but you know off the top of your head what they were. Were they similar in any way?
Yeah. So the question that Robert's asking is that diversified growth option that we offer in the MySuper under 75, are they similar? Yeah, they're very, very similar. I can't tell you they're identical. We do have small differences in the allocations there, but they're very, very close.
Yeah, exciting job you've got. I'd say it'd be pretty challenging in the current environment.
Yeah, so expected returns are lower than we would like, and so the challenge that we're doing, pushing through at the present time is how can you sensibly deal with that? Yeah. Right? We could go out and take a lot more risky assets into that portfolio, and it would raise the expected returns, but it's then very challenging for folks because it changes the risk profile. So the changes that Kate outlined before are fairly simple, and I'll spend a minute or so talking about them now, and I'd be happy to talk with folks afterwards in more detail. We are starting to bring some money home from overseas. So we're selling international shares and buying domestic shares. We think that they're better value, and we think they offer a much higher income in the current environment. We do like the idea of building more sustainable income in the portfolio. We're trying to move up the capital structure. So we're selling out of listed equities to some extent, but also out of government bonds, and we're investing into credit. We're lending money to people of various forms, whether that's emerging markets debt, it's infrastructure debt, it's real estate debt, it's regulatory capital arbitrage, it's bank loans and high yield. We think that middle part of the capital structure is more attractive at the present time than equities. We like infrastructure compared to property because it has a higher expected return and more certainty about the cash flows. So the changes that we're pushing through aren't radical, they're always going to be incremental. What we're trying to do here is boost that expected return by high enough to make a difference without dramatically changing the risk profile of any of the options.
Can I finish with I'll just put 2 questions together from the pre-submitted ones, and the ones that we haven't got to will be answered out of the meeting because we've got to wrap it up. But Mark asks, how are we doing transitioning our investments away from fossil fuels and towards renewables in line with the Paris targets? And Jones says, what ethical and climate change and innovations are our funds supporting? I think those questions are very much germane.
They are a good set of questions that does fit into these investment strategy changes we're looking at. So in the infrastructure portfolio, we've made an investment with a group called Lighthouse. Lighthouse specialises in disability and social accommodation. You may have seen a press release earlier in the year looking at some work we've done in Woolloongabba, for example. We think that those stable, predictable cash flows, which are backed by government contracts, are great investments in the current environment. And if we can do well by doing good, so much the better. So a big part of this strategy is about looking for certainty. but finding certainty that can generate sufficient returns so that members can build that retirement balance. Broader questions about ESG and fossil fuels. It's a really challenging thing for us to think about. We do have a number of investments that are related to fossil fuels without being involved in fossil fuel discovery or manufacture. The North Queensland gas pipeline, for example. The challenge we have is if we turned off all the fossil fuels tomorrow, the economy would grind to a halt. We literally have no alternative but to use fossil fuels for the present time. The International Energy Agency forecasts that even out to 2040, more than 1/3 of global energy production is going to be from fossil fuels. We do think there is a transition process underway. We're very interested in what that means for our current investments, but also the future prospective investments that we'd like to make. So we certainly think about those as we go about changing the portfolio over time. It's a really difficult thing, though, to think about what a fossil fuel-free investment looks like when you think about Scope 3 emissions. If anyone wants to talk about Scope 3 emissions, I'm happy to do so after the event.
Thanks, Troy. Much appreciated. And thanks to people who took the time to pre-submit a question and to those of you who've asked questions here in the room and online today. But we have to wrap there. So please note for people here in the venue that some of the executive leadership team is here, and John, of course, will be happy to answer your questions afterwards. And thanks to all our members for attending our second annual members meeting. We'll have today's video and minutes of the meeting available online in coming weeks. Please don't forget to fill out your survey, which will be emailed to you after the event, and collect a copy of the 2019-20 annual report before you leave. And for those that are interested, the LGIA Super staff on hand here in the Brisbane room can offer super health checks, and you can talk as well to members of our advice team to help you with any other questions you might have. I invite you now to join us in the exhibition area for some light refreshments. Please make sure, of course, that you maintain social distancing when queuing for food. And if there is a bit of a queue for food, that might be the time to come and have a super health check, for example, and go back afterwards. There's plenty there, I'm sure. Please take good care, and thank you very much for being with us today, and we look forward to seeing you again next time. Thank you. Good afternoon.